Hi, I'm Scott Robinson, Director of the REIT Center at NYU Schack Institute of Real Estate. I'm fortunate to be co-hosting our Fall REIT Leadership Series with my friend and industry colleague, Robin Panofka. Robin co-chairs Wachtell Lipton's real estate and REIT M&A practice with Adam Emmerich, both of whom have long supported the Schack Institute, notably as conference co-chairs of our annual REIT Symposium held every spring in New York City. Today's conversation with Dave Henry, co-founder of Peaceable Street Capital. Dave has built an incredible reputation over his career, including serving as vice chair and CEO of Kimco Realty. I'm very appreciative of him sharing his time and insight about the economy and real estate, as well as providing career guidance for our students. I also want to thank the many NYU Schack students who participated in the series, including today's co-host, Leanna Mayberg.
All right. Well, we are very fortunate to have with us today Dave Henry, who has had pretty much every job imaginable in our space, starting out at GE Capital and being chief investment officer there for a while, then running Kimco, the largest shopping center REIT in the U.S., non-mall shopping center REIT, I should say, and now Peaceable, a mezz loan investor, as well as sitting on multiple boards, Tanger, HealthPeak, the Starwood non-traded REIT, and recently the Columbia and VEREIT REITs, which engaged in major M&A transactions. So you all have the full bio. It's too long to go through, but Dave, with all of those hats you've worn over the years and continue to wear now, be great to start with your big picture outlook. What's your sense of the real estate market generally, the REIT market more specifically? How are you feeling about things with interest rates, inflation, all of that?
Well, the older I get, the more often I'm reminded that commercial real estate has always been and always will be a cyclical business, and so you have to be prepared for that. When I got out of graduate school, I joined a mortgage REIT back in the 70s called the Republic Mortgage Investors, and I called up my dad. I was all excited about joining a REIT, and he said, real estate, isn't that a cyclical business? I said, no, Dad, you should see it. We're putting out $1 million a week here, Dad. It's really a very neat business. 2 years later, Republic Mortgage laid off 90% of the people. Luckily, I was paid $11,000 a year, so they didn't lay me off. But it was my introduction to how severe the real estate cycles could be. Now, that was the mid 70s, and we've had a number of cycles since then, and that will continue. And I think we're headed towards another major cycle. We've been enjoying ever falling interest rates for almost 30 years now, ever falling cap rates, which drives real estate values for 30 years. And I think it's going to revert back to some sort of historical mean. The free money days is over, and the asset prices are going to adjust. When I got out of school, mobile home parks were trading at 12 cap rates, and nursing homes were 15 cap rates. And it wasn't that long ago that they were trading at 4 and 5 cap rates. So I think it's going to revert, and it's going to be a little bit ugly. You're already seeing it when apartment projects that Blackstone and Starwood bought at 3.5 are now worth 4.5 or 5 cap rates. That's a big adjustment in value. And so you're already seeing a lot of disarray from lenders. A lot of deals are falling apart. Rates are going up. Spreads are widening. Banks are getting, quote, hung with loans they made for private equity. They can't sell these loans down, and you're seeing them start to take losses and reserves on these loans. So, and the secondary markets are in disarray as well. So I think it's going to be an adjustment. Sellers aren't willing to accept the new pricing, and buyers aren't willing to pay the old pricing. So you're seeing transaction activity go down. But I think it's all part of a trend line to a readjustment, and it's going to be hard on the real estate investment trusts, which are public companies. They're already down 20% or something like that. And they're probably ahead of the private market a little bit, but the private market and the private REITs are starting to adjust. Blackstone and Starwood were raising tons of money 4 or 5 months ago. Now they're net negative because redemptions are exceeding the new raises on the private REIT. So everybody jumped into it maybe a little bit late. There's that old real estate saying, profits breeds competition, and excess profits breeds ruinous competition. So I think you may be seeing that in some of these very new private REITs that all jumped into the market, because it's a very expensive business to get into. It's people intensive. You need a lot of people to handhold the financial planners at Merrill Lynch and American Express and so forth. So the break-even level for a private REIT is $3 or $4 billion. And if these guys are raising 10 or 12 million a month, it's not going to fare well. So anyway, to answer your question in a summary form, I think we're headed towards another down cycle in just about all types of commercial real estate. You're already seeing it in residential real estate, right? With 7% mortgages, the home buying market is drying up. I lost the window of opportunity to sell my house in Greenwich when COVID crisis were driving everything crazy. Now there's a big adjustment coming.
So you've touched, very interesting, you've touched on the public REITs and the non-traded REITs and really the private side. How do you see this playing out on each side? I mean, REITs traditionally are far less levered and less dependent on debt than the private side. So even during the financial crisis, we didn't see very many. I think we saw one bankruptcy. Do you see much more real distress on the private side than the public side for that reason? Or how ugly do you think it's going to get on each side?
Well, I think on the public side, what you're finding already is that the blended cost of capital for REITs, because debt is up and then equity is way up when your stock prices are way down. So even the strongest REITs can't afford to grow and buy unless they use other people's money. So you're seeing even the most blue chip REITs like Boston Properties and others reach out to the GICs of the world, because at the end of the day, you need life insurance money, pension fund money, sovereign money to grow your business, because you can't compete with those guys. Their cost of capital is much lower than a public REIT. So you're seeing them all drift over to be the operating partners of choice for lower cost of capital. And I think that's the way that the REITs are going to survive. They're going to become operating partners and best in class operating partners in specific property types, like Healthpeak, where I'm on the board. We're going to be an operating partner in the healthcare real estate space for pension funds and life companies over time. And I think that's where the public companies are going to go. I think you're right. Their balance sheets are pretty strong. So it's not necessarily a question of bankruptcy and financial solvency, but there's going to be a lot of distress with their stock prices. You know, when you're a public company, as Milton Cooper used to say, you get a report card every day on your company. And when the stock prices are way down, you're getting D's and F's on your report card. And then there's a lot of pressure from activists. There's pressure from your board and so forth. So you'll probably see more management changes. The lifespan of a public company CEO is already equivalent to a North American beaver, about 5 years. That's going down by the hour too, as people search for the right path to growth. And unless you have that path to growth, you become what they call a zombie REIT. You can't raise new capital, you can't grow, and your stock price just lags. So yeah, there probably won't be a lot of bankruptcies. That's already gone through the mall guys, because the value of their assets went down 80% or 90%. But most other property types aren't going to go down 80 or 90%. So I think that the solvency is okay. The distress is going to come from both the lending side. Can you imagine if you were a big office building lender? You've got problems in River City. Nobody's going to refinance you out. There's no bid on some of these B and C office buildings out there now. So there is distress coming in the lending side and the private side in specific property types. I would point to office buildings, both suburban and urban office buildings as one critical path. If we go into a more recession, then hospitality becomes, you're already seeing the hospitality stocks start to suffer, because people are worried about what the recession will do to a real estate asset class that you have to rent every night. It's not like you have 10-year leases. I am surprised that the net lease REITs like Realty Income haven't suffered more because they're equivalent to bonds. There's no organic growth in those leases. They've got thousands of bonds, and as interest rates rise, generally bonds fall. So we'll have to wait and see about the net lease REITs. But you're going to see it month by month, week by week. There's going to be a little more distress there. It's going to take a while though, because there's still a lot of money out there looking for distress. All the real estate opportunity funds have renamed themselves. They're special situation funds now, and so it makes them easier to raise money, and so they will continue to put out money. As we used to say at GE, nobody gets paid for not doing deals. So even though probably the deals shouldn't be done, the deals are going to happen as people try to pick some sort of bottom.
Yeah, no, sounds like it's going to be an interesting period. So let's talk a little bit about retail. You ran Kimco, you're on the board of Tanger, you're on the board of REIT, Triple Net, largely retail REIT. How do you see things playing out, say the next 5-10 years in the retail space? Obviously everyone talked about COVID accelerating online shopping, but recently you hear a lot about the resurgence of physical real estate. People actually realize they actually like to go places and not just shop online. How do you see it?
It has kind of reached a stabilization level. The share of e-commerce sales have stabilized. The growth isn't geometric as it was. Retail in the U.S. used to be very over retail. I mean, we had too much retail space per capita, and there's been a lot of recycling of retail real estate into other uses. Some of them has gone into self-storage. I mean, it's amazing how many big boxes have gone away in one form or another. So the supply side has gone down. The demand side, after COVID and people wanting to get out, and if you're an open air retailer like Tanger is or Kimco is, you're doing okay now. The retailers are happy and they're expanding. The Marshalls of the world and the Ross stores, they can't find new space. So rents are going up, traffic is holding up, consumer spending is holding up. Now that's transitioning from people using some of the savings from their stimulus payments now to using their credit card. So that's something to keep an eye on. But Christmas shopping is good. Traffic at Tanger is back to pre-COVID levels. So the parking lots on weekends at the outlet centers are full. So and people are cautiously optimistic about the retail holiday season and consumer spending. So, and most retailers have acknowledged that if they're online only, they may not make any money. All those e-commerce guys that were selling like crazy, they were having to deal with 50% returns. The chances of you getting two shoes that exactly fit right, but made in China and exactly what you wanted. So the return rate on shoes is something like 60%. So people have found that they really need to have the physical brick and mortar. They need to build the brand. They need to have visibility. But look what Apple stores have done over time by having little tables where little kids can play on their first iPads and all that sort of stuff. So brick and mortar's here to stay, especially in the service business. You can't get your clothes dry cleaned on the internet, or your haircut, or your hairdresser, or your nails, and all that sort of stuff. So we're actually pretty optimistic about retail. And one reason is that retail still trades at decent yields. So whereas industrial and apartments were down at 3.5, retail was 6 to 7. So you can still make a positive spread on debt in the retail property type versus some others. So I think retail will hold up pretty well in this coming downturn.
Good. Well, an optimistic note after your gloom and doom.
Right.
So let me ask you about M&A, and then I'm going to turn it over to Scott and Leanna, and then I'll have some follow-ups. So you've been involved in quite a bit of M&A recently. The sale of the Columbia REIT, where you were on the board, to PIMCO, the merger of REIT into another large triple net REIT. Do you see this current environment and the possible kind of distress and change in management leading to a lot more M&A, or how are you thinking about that?
I think maybe incrementally, but M&A, as you know, Robin, it's a tough business. I mean, the sun and the moon and the stars have to line up. You have to have a board that's ready to sell. You have to have a management team that's ready to go home with the severance. You've got a company and it's shareholders and investors that are willing to throw in the towel kind of thing. It's very hard to do. I mean, we did a number of them at Kimco, but there was always a story behind it. So I think it will continue to be, half a dozen a year, but it's not going to be 30 or 40 REITs going away. Look at the Cedars of the world. The Cedar was there for, 15 years longer than it should have been. A $100 million market cap, and it's just. But it's too much of a good gig for everybody from the CEO to the directors to agree to a merger. I do think this proxy change is going to make a big difference because you're going to have more REITs put in play. I think that's what's going to happen. You're going to see the activists come in there, take a little stake and nominate themselves, and they're going to have a better chance of getting on the board, and they'll help stir the pot. But it's in general, it's difficult to put all those things together. All the ingredients have to be in place.
So you're not a believer that within a decade there'll just be 30 REITs left standing?
No. And for every one that goes away, there's a new one.
Yeah. Now we seem to have had 115 REITs for the last 20 years. So, but the big have been growing bigger.
Yes.
The Kimcos and others do seem to consolidate more and more.
Right, but you do have a lot of private funds and others that are doing consolidating plays. Marinas, self-storage. Now there's boat storage consolidators out there, and their exit is a public REIT someday. So you'll see more. But the big guys will have more advantages, but even they will have a more expensive cost of capital than your average pension fund. So I just don't see. I mean, look at Prologis. Their business model works because basically they use other people's money. They have all these funds. They build and sell into their own funds, and they have the scale now and international diversification and so forth. So I think that's the right model. It's been in and out of favor among the analysts because you're not totally in control of your assets. So the analyst community doesn't like it that much, but I think that's the reality because the blended cost of capital for REITs is just too darn high unless you're in some sort of marginal real estate with super high yields.
So just to kind of break it down for the students, the reason that model works is because the REIT acts as the manager and earns fees and a promote, which juices up the returns to satisfy the public market demands for the dividends. But if they just bought the asset 100%, the yield would not be sufficient.
Right. Look at the Blackstones and Starwoods of the world, and the Fidelities and the Vanguards. They make money, and enormous amounts of money, by managing other people's money. I remember that cartoon where everybody was looking at these yachts in a harbor and say, how come they're all owned by money managers and not investors? and there's a reason for that. Is the fees, once you get to a certain level of scale, are enormous. I mean, and the BREIT's performance fees, which is their basically promote for just one of their funds, BREIT, was $1.5 billion last year. So that's just the bonus, right? They also get asset management fees and other fees as part of it, but the promote side of it for BREIT was $1.5 billion. So that's why Steve Schwarzman made $600 million last year, or whatever. It's that's how you get rich. It's all about scale and the fee structure. And that's not even the hedge fund structure of 2 and 20. That's just it's a more modest structure. But if you manage $1 trillion, it's enormous.
Starts adding up. Scott, let me turn it over to you.
Yeah, a couple questions. I want to build off that one first, though, Dave. Thanks again for joining us.
Sure.
Do you think if we are at the end of a secular bull market in debt, do you think a reversal of interest rates like we're seeing is going to have a negative impact on private equity economics, and that could kind of tilt the scales a little bit more toward the REIT structure?
Well, private equity model is interesting too, because they're coming under pressure too. And even though you're seeing the 10-year go from 4.2 to 3.6 or whatever it is, it's not enough to bring back the good days. So you're seeing private equity multiples start to go way down. The fast food restaurants that used to sell at historic 18 or 19 times, they're drifting back to 14 or 13 and probably on their way to 10. There's going to be resetting of all kinds of asset classes based on much higher interest rates than the free money essentially we've been dealing with. I mean, it's just it was kind of crazy. You could borrow a home mortgage at 2.5% or something like that. That hasn't been around for forever. So the good times are over, and it's gonna be ugly on all kinds of valuations, I think.
Yeah.
And it may take a while because, as I said, there's a lot of money that people have raised that still needs to be put out in some form or fashion. A lot of these funds only get paid on invested assets, so they actually need to put the money out to start getting those fees. So they may tend to overpay a little bit, but the private equity model is under some pressure now. It's tough to raise new funds. Valuations are going down, and those guys have to mark to market at the end of every year or so.
Yeah. In your opening comments, you mentioned the strategic or special situations strategy, nomenclature there. I don't know that we're there just yet. We'll probably be increasingly getting there into next year, but we are hearing more from equity investors who want to provide gap financing, kind of bridge that shortfall of where lenders are. In many respects, that's the place that Peaceable plays with your preferred equity strategy. So are you seeing more opportunities? Are you thinking there's going to be more for you, or how are you kind of viewing that gap need out there?
Yeah, so up until recently, 99% of our business has been acquisitions. I mean, we provide basically 2/3 of the equity. Somebody needs to buy a shopping center, an apartment project, and almost all of our business has been acquisition. But recently, we have been contacted, and we are looking at some deals. In fact, an interesting one in Hawaii, where the construction lender can't get refinanced out completely. So there's a gap. In that case, there's a $10 million gap between what a new first mortgage will lend, because rates are higher, underwriting's tougher, lenders have pulled back a little bit. So that is an opportunity for us, and I think we are going to see a lot more of that gap. It's not rescue capital, but it's close. It's kind of gap capital, and we can get well paid for that. And the Blackstone people will tell you they think there's lots more opportunity in lending right now than equity investing, because they can get 8 or 9 or 10% on pretty safe debt, because the traditional lenders don't want to jump into real estate right now. And the regulators are putting some pressure on banks to be careful of their real estate exposure. So that's also out there, and banks listen to regulators. So just about all the institutional lenders are getting a little more cautious about their real estate exposure.
Yeah. Look, as you said earlier, I think those of us with gray or less hair have been through a few cycles, and we see that there's opportunities in each cycle. It's not just downside risk, but I think our students don't know that just yet. And so they have lots of questions about, launching their careers in this environment. So maybe I'll hand it over to Leanna to pose a few questions on behalf of our students.
Hi, David. Thanks for answering some of these questions I have. Okay, so I think the first question is, so as a student starting out in the real estate industry, maybe perhaps when you're looking at your new hires, is there anything you wish that they had a more advanced knowledge of when they're starting out in this field? Something that we can focus on?
Yeah, the one recommendation we make to all these the people that we hire and the new students is get the Argus skills. Argus is a basic building block for our business and most real estate analysis. That having that Argus knowledge, and it's not rocket science, but you need to take a course in it and study it. So having Argus skills on your bio or your resume is important. And so that's one thing I would definitely tick off. but basically, we're looking for even entry level people with financial skills and a willingness to work and personality skills. It's tough. We interviewed a guy the other day for a kind of an analyst position, and he says, "I want you to know, if you hire me, I'll work a full 40 hours, not more. I'll work a full 40 hours." So, I come from a generation where you're expected to pay your dues. You were expected to work hard, and you would never say something like that in an interview. So it's a little bit of a new world for us, and then for the kids that are coming out with pretty lofty expectations. At GE, we were always careful about hiring from Ivy League, Harvard, or something like that, because they came in wanting to be vice president in charge of Fig Newtons the next day, and we were much better off with a mid-level guy from Idaho State. Milton, you'll like this, or Milton also had to say, you can always tell a Harvard man, but not much. So. So anyway, that's so I think coming into an interview, being upbeat and cheerful and enthusiastic. I mean, real estate is a wonderful career. I stumbled into it. I got an MBA from University of Miami, and the head of the business department happened to be a trustee of this mortgage REIT. So I just stumbled into it. But at GE, I saw so many different businesses, and people that came into real estate tended to stay and enjoy their career, and the people that were processing credit cards or equipment financing, it's much less satisfying. Real estate is all about deals. Every deal is different. You get to meet people. You get to go see real estate. It's a good business, especially if you've got some sales skills, or you like selling a little bit. That's obviously where the money is on the deal making side. But even the people that are processing the deals, and asset managers and loan administrations, they have good careers there too. Again, you have to understand you'll go through cycles, and companies don't have a lot of loyalty anymore. So my kids have all been mercenaries. They're doing very well. One's at Blackstone, one's at RBC, but that's their third job, and they're in their mid-30s. So it's that's the way you don't climb a corporate ladder anymore. You spin out. So there's a new reality.
Thank you. So you mentioned interviewing. So within the current economic climate and this real estate cycle, is there anything you'd recommend specifically for a student to do in an interview that stands out, besides saying they'll work at 40 hours a week?
Yeah, obviously be enthusiastic. Don't talk too much. That's always a little bit of a turn off. You have some guy, you can't get a word in edgewise. That's, you say, holy moly, I don't know what I can work with this guy. He's talking. And sometimes it's just nervous energy, but I would caution them on listening, and then responding and cutting it short a little bit. But that's also an interview thing that it comes out to me. But don't be afraid. If you're a history major, whatever. People are looking for bright people that are enthusiastic and maybe some base financial skills. And like I said, something, if you do have some Argus experience, and if you have some summer intern experience with the mortgage bankers or investment banking, that's very helpful as well.
Thank you.
Leanna, we'll come back to you in a few minutes. I wanted to drill down a little bit more, Dave, on how at Peaceable you're underwriting things like that deal you mentioned in Hawaii, where you're coming in for that kind of gap. What kind of discounts are you putting on assets? How do you get comfortable that the asset's going to be worth more than the debt plus what you've put in?
Well, first of all, we're looking to lock in a spread. So if the debt today, fixed rate debt, and we're looking for at least 10-year fixed rate on an income property, if it's, let's say it's 6, we're looking to lock in a spread, 7-8% on top of that. The valuation is a bit of an estimate, but our underwriting is all about the cash flow. We don't believe in appraisals. We'll send in our third-party auditors, and we will know what that cash flow is coming from a lot of different leases. So for the next 10 years, using Argus, we'll know what the cash flow is going to be, and we'll audit today's cash flow. So you marry that against fixed rate debt for that 10 years, we've locked in a spread. So the cap rate, the exit cap rate is a little less sensitive. And the other thing we're religious about doing, we charge 8 to 9% as a preferred interest rate, but we always take a piece of the deal. So we'll have 25 or 30% of the upside. And you need that equity upside if you're going to be in the mezz business, because it's a little bit risky. You're sitting behind a big first mortgage, and values change, and operating partners sometimes have bad strategies. So we're successful over the cycles. We did the same thing at GE and Kimco by always making sure we have a big piece of the equity upside, and that will take care of some losses. If your operating partner hits a home run, you want to hit a home run. So I don't really understand the mezz guys. The best they can do is get their interest rate at 10% or whatever they're getting. They don't have any equity upside. So that business is a tough business. And if you look, there are no mezz lenders that have been around for 20 years. They just all wash out the next downturn because they don't have the equity upside of their good deals. So that's just my 2 cents. We've also played it pretty safe because we're in multifamily, which has done very well, apartments, and should continue to do well. We're in neighborhood shopping, so your grocery anchored shopping centers, your open air shopping centers. We're in self-storage, and we're in RV parks, the guys that drive the Winnebagos. All of those are pretty safe and stable asset class. We don't do office buildings, and we don't do land loans and some of the more riskier stuff. So the portfolio's held up pretty well, and that strategy of focusing on the safer asset classes, making sure there's cash somewhere between 10 and 12% of the total capital structure that's fully subordinate to us. So these operating partners have a lot of skin in the game, getting equity upside, and then auditing what the net income is. That's basically the core parts of our business.
I don't know how you had the foresight to avoid office. It seemed pretty safe a few years ago, but
well, but 40 years teaches you something. At GE, we went back and looked at where our losses and impairments were, and we financed everything, including non-performing loans in Thailand and condo conversions in Sweden. 85% of our losses over the years were office buildings in suburban or urban locations. So it's just a tough business. It's in a downturn, you've got to drop your rents, you've got a big TI package, you've got to put in free rent, you got to pay commissions. And some of those, by the way, some of those A tenants you thought you had turn into F tenants. They get bought out by private equity, they go bankrupt. And so office is a tough asset category. I mean, look at New York City. The net rents of office have been the same for about 40 years. It's about $30 because taxes keep going up and all the other parts that make up net rents, and versus apartments that have gone up 400% or something like that. So it's an easy call to stay away from that. And I think look at the stock prices of the office REITs today. I mean, everybody's
you turned out to be right, but
right.
wasn't obvious to me.
Right.
Let me ask you this, both in terms of your own company and generally how you think about it. I mean, how do you feel about remote working for young people, older people, and what happens to all these buildings around me in Midtown Manhattan?
Well, I'm personally struggling with it. I was just thinking about that on the ride today. We've compromised with our people with 3 days on: Tuesday, Wednesday, and Thursday, and Monday and Fridays are optional, and almost nobody's in the office on Mondays and Fridays. And I, the team says it's working. Leave it alone. Don't touch it. It's and it's a great team, and they're doing well, and they're working well. But I come from an environment where you put on your helmet and you went into the office at least 5 days, if not 6 days. But I asked myself, though, if you're commuting an hour each way, wouldn't I rather have those guys working at least an hour of that 2 hours, doing something very productive rather than fighting traffic. So I don't know where we're going to come out. I guess we'll leave it alone as long as we're doing fine. People seem to be happy with it, but we tried last fall. When COVID looked like it was dying down. If you remember, this was, I guess, last fall, and we said, okay, time for everybody to go back to the office. We had a revolt. I just bought this house. My wife's pregnant. We're having this baby. We had this short thing. We're not, So, okay, we surrendered. And it was very tough to hire people. And so we surrendered. And now we're back to, seems to be working. So maybe we'll leave it alone and we'll let other people experiment on how good it is to force people to come back that don't really want to come back and have gotten used to having a little flexibility at home.
So what happens to all these buildings?
That's why there's no bid ask on the B and C buildings in New York. The only things that's renting are the A+ stuff. Where at Columbia, we did 799 Broadway, which is a brand new building near Trinity Church, and we rented the top floors for $240 a foot. But the other buildings we have, we can't give it away. It's going to be tough. It's going to be tough. A lot of those buildings will be recycled into residential or other uses, and you'll see some of that. It happened after 9/11. If you remember, downtown, a lot of those B office buildings became residential. So I think you'll see some more of that. But it's going to be tough for lenders. It's going to be tough for owners. And meanwhile, these local laws that New York City passed, that you have to have a lot of new capital coming into these buildings to meet these new standards, green standards. And if you don't, there's enormous fines. There's huge fines, and I don't think they're going to relax that stuff. So it's going to be a tough go for office. And you put on top of that a recession. Besides that would work from home, and also you have quality of life issues in New York City. I mean, my daughter won't ride the subway anymore. She had a bad experience. Some guy pulled down his pants in front of her, so she's never going back. So that's also an issue. People don't realize that, but the ridership is not. It's half of what it used to be in the old days. So I think. It's not as much fun as it used to be be part of that commuting crowd. So I think employers are going to have to wrestle with that unless they want to drive away some of their very best people.
Liana, as the spokesperson for your generation, how do you think this shakes out? Remote working, etc.
So I understand that a lot of my peers do prefer to work from home. So it's very different from the normal work environment. But with the subways, they claim the subway will be bankrupt in 2 years if people don't start commuting at least 3 days a week. So just as a student, how is that work environment different? I feel like we're not making the same personal connections as we would get if we were working full time in the office. What's your opinion on that?
Well, I do think if you're 3 days in the office, there's still plenty of opportunities to mentor and build relationships and learn the business and stuff. If it's 100% remote, I agree with you. That would be very tough. And guess who's getting laid off in these first rounds? It's not the people in the office. It's the work from home people that are getting an email saying your services are no longer required. What it must say, the ones that don't want to come in to work, resignation accepted, or something like that.
Yeah, hardcore only.
So I saw that at GE many years ago. The people that were in the home office, you generally got the promotions. The people that were in the far out branch offices, so I think the same sort of thing's going to happen. If you really want to advance your career, you're going to have to be part of the decision-making group. And that's probably in the office, and it's not a remote situation. Plus, it's good to interact with people. And real estate is a people business. So it's important to get out there. And even our people that work from home, I tell them, we're very happy for you to go out and see the real estate, meet with our operating partners, meet with our borrowers, meet with our clients, go to conventions, go to courses. We'll pay for it. I mean, we encourage them to get out there and interact in some form of fashion and learn. And And so I think that's important. But I think you can, what was the magic of a 2-day off and 5 days on? I mean, I don't, so.
No, it's mystifying to me. I mean, part of the fun of the whole real estate business is the assets. That's why it's different from credit cards or whatever. But people don't seem to want to see the assets anymore.
Well, part of it is, I mean, nobody wanted to die of COVID either.
Yeah.
There were refrigerator trucks filling up with bodies, so that wasn't exactly conducive to going out for a couple of years. So we've all been learning to adopt from home for a couple of years now. So there's probably a middle ground where we get a little more flexibility in our careers. But at the end of the day, the people that are going to succeed are the ones that work hard and willing to make extra effort. And that extra effort may be a commute. It may be going to see a property, or maybe spending a little extra time at the computer or whatever. But that dynamic of how you succeed in business hasn't changed. It's a combination of being lucky with the right company, having the right boss, working hard, having some skills, enjoying what you do. That's the nice thing about your generation. You get to try until you find something you like, because there's no stigma to having 3 jobs, 4 jobs, 5 jobs. So you can try something and make sure you enjoy going to work every day. Once you get a mortgage and 5 kids, that's more difficult.
So
more difficult these days.
I have a couple of questions about the non-traded REITs, but Scott, anything on your end?
It's kind of hard to follow up with anything after the sage advice from my students. Maybe I'll end my session with one quick question. A lot of my students also want to, they have more entrepreneurial spirit, and they want to go on their own and buy property. Peaceable makes, I'll call it smaller to lower middle market, preferred investments. Would you support entrepreneurs, or are you looking for more seasoned operators?
Generally more seasoned operators, but it is all about the real estate. So if somebody really finds a very good opportunity, we'll be happy to look at it. But a lot of these, especially like an RV park, that's something that an inexperienced person shouldn't be doing, because it's really an operating business. The same as hotels, right? It's not 100% real estate. It's more of an operating business. So to the extent that you rely on some operating skills, you need some experience, and so we get comfortable. And our strategy is to follow operating partners. So if we've got good borrowers and good operating partners, we'll go where they want to go. We don't target Boston and parachute into Boston and go look for deals. We look for good operating partners. And in our case, we have 40 years of experience with some of these people. So we follow operating partners.
That makes sense. Thanks.
So question on the private side, and then Leon, I'll give you the last question. So you talked a fair amount about the cost of capital for the public guys. But one thing I hear a fair amount about is the non-traded REITs and even the PE model is so dependent on debt, that with interest rates going up and them having to some extent relied on cheap debt to pay the regular dividends to people, don't you see distress coming on that side? I mean, doesn't that whole model start suffering when debt is twice as much as it used to be?
No question. And in real estate, we're going to have to make money the old-fashioned way. We're going to have to grow the net operating income. We can't count on a low cap rate or low debt to bail us out. So in our business, we're going to need to finance properties where there's a business plan to create value. Let's say apartments. You're going to renovate the apartments, you're going to charge higher rents, and you're going to grow the net income that way. So there's going to have to be more focus on how you're going to create value, and not just rely on cheap debt. You're right, and it's going to be very tough. So existing private equity, their portfolios are going to go down in value. And for raising new money, it's going to be very hard to find new deals unless you can buy something a lot cheaper and use a lot less leverage than you're used to. So that's why I said, for instance, my partner has bought a lot of Taco Bells. at high multiples, and it's been a very good business for him. But those multiples are going to come down. So he's going to have to run faster to create more revenue, more EBITDA at the Taco Bells to justify the fact that the end valuation of his portfolio is probably going to be lower in terms of a multiple.
And hopefully he doesn't have too much debt on them.
And not floating rate. That's the one thing we did caution him, and he fixed most of the debt, so he's okay on that side. But you know, he's the largest owner of Taco Bells, but it's also a very good business for a recession, because Taco Bell business actually goes up in a recession because it's so cheap, and so that sort of stuff. So it's what I'm amazed about private equity is how my partner can underwrite an aerospace business in upstate New York, Taco Bell's in Kentucky, and urgent cares in California. I mean, it's just a different skill set, these private equity guys. So they're quick studies. They're very, very smart. It's just an interesting business, but very different. I mean, in real estate, we talk in terms of IRRs, internal rates of return. They talk in terms of multiples. So it's just almost a different language in private equity and real estate.
Well, unfortunately, we're getting close to out of time. Liana, you get the last question.
Great. So you mentioned that you liked working with more seasoned operators, but as a soon-to-be graduate and some of my peers looking to go out on their own, how would you recommend starting our careers and becoming a successful, more seasoned equity investor in commercial real estate?
Well, I don't think they should leave school and go out on their own, quite frankly. I think they should team up with, if they like the entrepreneur side, team up with another smaller, don't go work for B of A, but go work for somebody that's a 5-person shop or a 6-person shop that has done a few deals. But don't go out with your dad's checkbook and go try to buy a building and make a lot of money. Learn the business a little bit with somebody that's already in business, because the academic learning is great, but there's no substitute from actually working with somebody on deals. So I don't think it's a great move to just jump in the water without any real experience.
Okay, great. Thank you so much.
Makes a lot of sense. We'll see how many people ignore that good advice.
Well, like I said, when you're young is the time to jump.
Yeah. Worst comes to worst, you go get a job in a couple of years. Well, Dave, that was fascinating. Thank you so much for your time. Really appreciate.
Always fun.
We'll see you soon.
Thank you, guys.